Hi guys, welcome to my YouTube channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about tax planning and strategies. So make sure to watch the full video. Income tax planning is a process that helps you reduce your tax liability by taking advantage of deductions and credits while timing income and expenses. Income tax planning involves analyzing your financial situation as well as the IRS tax code, so you can minimize your tax liability. There are many ways to minimize your income taxes, such as postponing income and accelerating deductions, or controlling when income is recognized. While tax planning is an ongoing process, the goal is to minimize your income tax. By taking advantage of income tax planning strategies presented here, you can reduce your taxes and keep more money from what you make. Why is income tax planning important? Income tax planning is an essential part of any financial plan for individuals and families. Proper income tax planning allows you to reduce or defer your income, increase your deductions, maximize your tax credits, and structure your investments for tax efficiency. Income tax planning is important because it helps you reduce your tax liability. By taking advantage of deductions and credits, and by timing income and expenses, you can minimize your income tax. Tax planning might seem complicated and overwhelming, but a good CPA tax advisor or tax attorney would guide you through the process, so you don't pay more than what is required by the law. Income tax planning is vital for the preservation of your wealth. When should I start income tax planning? Ideally, you should start income tax planning as early as possible in the year. This will give you the most time to take advantage of opportunities to reduce your taxes. However, it is never too late to start planning. Even if you are already in the middle of a tax year, there are still strategies that you can use to reduce your taxes. Although tax planning should start as early as possible, it is often done near the end of the year. Year-end tax planning allows you to take advantage of deductions and credits that may expire at the end of the year. It also allows you to control when income is recognized, which can impact your tax liability. By considering income tax planning as an ongoing process, you can ensure that you get the best possible result in minimizing your taxes. Income tax bracket. Income tax planning starts with an understanding of your income tax bracket. Currently, there are 7 tax brackets to compute your income tax: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Your tax bracket is the rate you pay on the last dollar you earn. However, as a percentage of your income, your effective tax rate is generally less than that. That's because the first dollars you earn are taxed at a lower rate than your last dollars. To calculate your effective income tax rate, divide your total taxes by your income. The United States has a progressive tax system. This means that people with higher taxable incomes are subject to higher tax rates, while people with lower taxable incomes are subject to lower tax rates. Common income tax planning strategies. Income tax planning should be incorporated into your day-to-day activities, but most people don't think about their taxes until it is time to file their returns, at which time income tax planning may be too late. Tax planning is something that should be done all year long. Income tax planning is vital for the preservation of your wealth. In this article, you will find various tax planning strategies for you to consider so you can lower your income tax. Reducing income. The first step in tax planning is to reduce your taxable income by investing in tax-free vehicles, such as municipal bonds, maximizing your retirement contributions, deferring capital gains, selling properties in installments, and arranging for like-kind exchanges. These and many other strategies explained here will reduce your taxable income. Increasing tax deductions. Many people pay more tax every year than they are legally obligated to pay because they miss out on many tax deductions. Make sure that your tax advisor is taking advantage of all the tax deductions that you are eligible for. This includes knowing what expenses you can deduct, such as business expenses and investment expenses, as well as knowing when to itemize your deductions instead of taking the standard deduction. Maximizing tax credits. There are many different tax credits available, such as the child tax credit, the earned income tax credit, the education tax credit, the energy tax credit, and many others. By taking advantage of these credits, you can reduce your taxes. Timing income and deductions. Another important tax planning strategy is to try to minimize your tax liability by timing your income and deductions so that you are in a lower tax bracket. For example, if you know you will be in a lower tax bracket next year, you may want to defer some income into the following year. Alternatively, if you are in a higher tax bracket this year, you may want to accelerate some deductions into this year. Restructuring investments for tax efficiency. While your current investment structure may have made sense in the past, it may not be the case anymore due to changes in tax laws or changes in your personal circumstances. For example, you can incorporate your business to take advantage of the low corporate tax rate, or you can change the holding of your real estate investment from a corporation to a limited liability company to avoid double taxation. You can also hold investments in a tax-deferred account if it is more advantageous than holding them in a taxable account. Improving your tax knowledge. One of the most basic tax planning strategies you can do is to understand the tax concepts that can give you the biggest tax deductions. Knowing which areas of your tax laws you can work around, which areas save you money, and knowing what tax records to keep would help you reduce your taxes without getting in trouble with the government. Working with tax professionals. You should also work with tax professionals, CPAs, or tax attorneys to keep you informed of the ongoing tax law changes and how they impact you. Potential planning opportunities. Here are some of the most common income tax planning strategies used to minimize taxes. Some of these strategies may or may not work for you, but we can guarantee you that if you go over these strategies with your CPA tax advisor or tax attorney, you will be able to find ways to lower your taxes. Deferring, postponing, income to future years. One way to defer income tax is to postpone income from one year to a later year. This can be done by holding off on receiving income until a later year. When you defer income, you also postpone the payment of taxes on that income. By transferring income to the next year, you minimize your current year's taxable income. Transferring income from one tax year to the next year can lower your federal income taxes if you are in a high tax bracket this year, but you are in a lower tax bracket next year. Income shifting strategy, high to low tax bracket. Income shifting is a well-known income tax planning strategy that transfers income from high to low tax bracket taxpayers. You may be able to minimize your federal income tax by shifting income to family members who are in a lower tax bracket. For example, if you own a business and your kids help you with the business, you can pay them salaries or wages for their work. The income will be taxed in their hands at their lower tax rate, instead of being taxed in your hands at your higher tax rate. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.